Picture this for a second. You're 63 years old. You've been diligently checking your portfolio every morning with your coffee. And then one Tuesday you wake up and the market's down 4%. Then it's down again the next day. And again. And suddenly that number you'd been mentally circling, the one that meant, okay, I can retire now, is shrinking right in front of your eyes like watching ice melt on a hot sidewalk. Except this ice represents 30 years of your life's work. Your stomach drops. You start doing math you don't want to do. Should I delay retirement? Should I sell everything? Should I just not look at it for a while? Yeah. I think almost everyone who's ever gotten close to retirement has had some version of that moment. And honestly, it's one of the cruelest tricks that the markets play on us. Because the moment you need stability the most is often, statistically, when volatility decides to show up. My name is Rick, and I spend an unreasonable amount of time thinking about money. Specifically, why some people sail through market crashes basically unbothered, while others feel like their entire financial future just got mugged in broad daylight. And here's the thing. It's almost never about being smarter or having some secret hedge fund connection or timing the market perfectly. It's about a handful of decisions, some made years in advance, that quietly insulate people from the chaos. So in this video, I want to walk you through what the smartest, calmest retirees actually do, not in theory but in practice, to make market crashes feel like background noise instead of 5-alarm fires. And by the end, I think you'll see your own retirement plan a little differently. Maybe even breathe a little easier about it. Let's get into it. Okay, so here's something that took me an embarrassingly long time to really internalize. Most people, especially people who've spent decades accumulating wealth, are trained to look at one number, the portfolio total, the big number at the top of the statement. And for most of your working life, that's actually a useful number. Bigger is better, the trend matters. You want that line going up and to the right. But here's the problem. That number is also the most emotionally volatile thing you could possibly stare at during a crash. Smart retirees, the ones who don't panic sell in March of a bad year, have usually made a mental shift. They've stopped asking, how much is my portfolio worth today? And started asking, how much income is my portfolio generating? And is that income still showing up? Let me give you an example. Say you've got a retiree. We'll call her Diane. And Diane has about $1.2 million invested, generating roughly $48,000 a year in dividends, interest, and systematic withdrawals. Now the market drops 25%. Painful, right? Her portfolio is suddenly worth $900,000 on paper. But here's the thing. Her dividend-paying companies, for the most part, didn't suddenly stop paying dividends. Her bond interest didn't stop showing up. The actual cash flowing into her checking account every month barely budged. The number that actually pays her electric bill and buys her groceries kept doing its job, even while the number on the screen was having a meltdown. That's the disconnect that smart retirees have learned to exploit in a good way. The portfolio value is a snapshot of what things would be worth if you sold everything today, which you're not doing. The income is what's actually paying for your life. So, practical takeaway here, if you're getting close to retirement or you're already there, try building or asking an advisor to help build an income statement for your retirement. Separate from your portfolio statement. List out Social Security, pensions if you have them, dividend income, bond interest, any rental income, annuity payments. Add it up. That number, that's your actual financial reality during a crash. Watch that number instead of the scary one. It moves a lot less, and honestly, it tells you a lot more about whether you're actually okay. All right, this next one is probably the single most important structural decision smart retirees make, and it's deceptively simple. It's often called the bucket strategy, though honestly the name doesn't matter. The logic is what matters. Here's the basic idea. Instead of having one giant pile of investments that you draw from indiscriminately, you split your money into, typically, 3 buckets based on when you'll need it. Bucket 1 is cash and cash equivalents, basically money market funds, high-yield savings, maybe short-term CDs. This is your near-term spending money. Think 1 to 2 years of living expenses, sitting there, boring, safe, doing basically nothing exciting. And that's the point. Bucket 2 is intermediate, bonds, bond funds, maybe some conservative balanced funds.